So good morning again. This is Charlene Brown with the Partnership for Responsible Financial Inclusion. I want to thank you for joining us. Before I turn the floor over to today's presenter, Fatima Nahar, I want to give you some brief background around the Partnership for Responsible Financial Inclusion. The partnership is a collaboration among 10 leading international organizations focused on advocating for responsible delivery of financial services. The partnership's collective footprint spans 260 financial service providers, serving 72 million clients in 73 countries around the world. With support from the IFC, we have been able to undertake this research project in coordination with two Bankers Without Borders volunteers over the last 6 months. The project was intended to evaluate the midterm financial results of a cohort of 22 certified entities. Our aim was to determine whether or not positive changes in financial performance could be correlated to the period following certification. Fatima Nahar, one of the researchers, will be sharing some of our findings. We have reserved 20 minutes at the end of her presentation for questions. And so without further ado, I'll turn the floor over to Fatima.
Good morning, everyone. From wherever you're signing in, I have signed in from Canada. It's extremely cold outside. So to get started, our second research consultant isn't here with us. We started this project back in August, and we are pleased with the results that we have found. Essentially, what we have aimed to do in this research paper is manage the gap in understanding quantitative information of the costs and benefits of getting SMART certified. A little bit about myself. I have always wanted to work for Bankers Without Borders, especially in the space of microfinance ever since my undergrad years. And finally, I decided to work on this project because I can finally contribute some of my expertise. I have previously worked on a KPI project for Oil Sands Canada with Shell and McKinsey. I was able to lend a lot of the expertise that I had gained through that broad project to this. Oddly enough, it is transferable information. So without further ado, we'll move ahead with the rest of the presentation. A quick note on the flow of the presentation. I will describe our research methodology, scope, and overall perspective of this paper, and then we will deep dive into the results to see how our cohort of the 22 FSPs has done. So in this first slide, I divided up logically what the pieces, the components that went into our hypothesis. First and foremost, this has to do with SMART certified institutions. So for those of you who are not familiar with that, SMART certification is an initiative that was taken in response to lack of client protection regulations within the industry, as it is less mature than the commercial banking space. You can read in the green bubble all the client protection principles in its broad categories. In general, client protection principle looks at prudential product selection for clients. So meaning you're not overselling them that they cannot pay back their loans. Ease of access for services, diverse products through multi-channels, client service standards, and due care, so they feel respected when they are dealing with their officers, and guidelines for pricing and interest rates. In broad terms, it's much more in depth than that. It takes around 6 months for financial service providers to get ready for this, and I think the investment is somewhere around $15,000, depending on the size of the institution. Next, up top in the gray and brown bubble, you can see that we're looking at internally driven indicators of growth and externally driven indicators of growth. So whether or not an FSP has an internal locus of control of the factors that's going into measurement of a performance indicator is important. And secondly, some indicators are externally driven and they're based on business growth, which may be spurred by factors out of their control. So we take those two perspectives into consideration when we are measuring their performance. And finally, in the blue bubble, to normalize any background noise and give context to the results that are emerging, we looked at the EIU microscope study. They have done a tabulation of the enabling factors of microfinance environment since, I believe it's 2010 to date, and we have taken all of those tabulations over the years, and we have tried to factor that into our conclusions. So a quick refresher on KPIs. These are basically the metrics that a CEO would see on their dashboard. They're pretty common throughout the industry. It's consistent. However, within this space specifically, there are some normalizations that happen within these formulas that should be considered. We have, in general, followed mixed database definitions for the formulas. So performance metrics are monitored by external. So they're generally monitored by internal and external stakeholders to gauge profit, productivity, and growth. Mixed market published global benchmarking data for Eastern Europe, EAP, Eastern Asia, MENA, SAS, and South Asia for 2013 to 2016. We should note that we don't have any FSPs within MENA, so that's Middle East and North Africa. And also KPIs except financial revenue and financial expenses have been discussed in this presentation. If you'd like to go more in depth with the definitions, then I would recommend that you go ahead and read the paper. These KPIs are also suggested in a paper in Microrate as being the accepted and most monitored KPIs in the space. Next up is characteristics of our cohort of the 22 financial service providers that we picked. And the reason we have picked these specific FSPs is because these were the only ones that were available since 2013. This is still in its nascent year. So although 100 FSPs have been certified since the inception of Smart Certification, we only have data for a 3-year period that we determined was significant in terms of performance measurement. And we came up with the 22 FSPs. They range from Eastern Asia, EECA, Latin America, and South Asia. And a quick profiling of the FSPs will give you that 7 of them are operational for less than 50 years and 15 are operational for greater than 15. So they're all in the mature space in terms of their years in operation. 8 of the FSPs are banks, 9 are NBFIs, and 5 are NGOs. And this dispersion is actually consistent with our regional mix benchmarking as well. So it's a nice dispersion in terms of an apples to apples comparison for legal entities. Most of them are in tier 1. We have a handful that are in tier 2. So tier 1 are above 31 million USD and tier 2 is within 25 to 31 million. I should also make the note that in our regional benchmark that we're comparing this to, there are probably more tier 3 institutions than our cohort. So it's safe to say that you're looking at best in practice institutions in terms of our cohort. Although we haven't quantified that, it's most likely the case that they're good performers anyway to begin with. Next is our research methodology. So as usual, there's data gathering, data processing, and coming to a conclusion regarding our data. Most of our data was primarily taken from mixed database, so it's consistent in that sense. If we had missing data, which we had some, we looked at either audited financial statements to manually calculate the data, or we looked towards the SMART team or reached out to the FSPs themselves to give us some of their data. The IU microscope studies we fetched from the internet. The mixed regional benchmark is readily available on their website as well. So for data processing, we defined two periods as pre and post. Pre was 2011 to 2013, and post was 2014 to 2016. The median year for certification is around in between 2013 to 2014. So in our judgment, we think that the period for certification is more important than the exact date of certification. Reason being, A, they're already in the process of implementing these client principles, and it takes a little bit of time for impacts to show up. It's not immediate or instantaneous. So it's safe to say that having that cutoff at 2013 to 2016 wouldn't really impact our data in a material way. The second point here is we use either cumulative aggregated growth rates or simple average to calculate the KPIs. And finally, we internally, this is not presented in the paper, we looked at variance analysis to look at any anomalies year over year. You may also point out that from 2013 to 2014, that period's missing. We did check for that over a 5-year period in our internal calculations and data quality checking. And finally, as I mentioned earlier, when we came to our conclusions, we just didn't look at the raw data results. We tried to tie that in with external macro factors, specifically through the EIU study that we thought broadly touched on all of the client principles. And we did map this. You can have a look at it in the appendix of the paper. So finally, data disclosures. Whenever data wasn't available, we adjusted the denominator. We set materiality at 1% of the MFI with the smallest portfolio for manually calculated data. Another thing we should mention is Mongolia is one of the countries where we have a representative FSP. In the regional benchmark, Mongolia is listed under EECA. However, with EIU and Charlene's previous research, it's grouped under EAP. So we stuck to EAP, and we checked for how mix's regional benchmark actually gets affected if we take out Mongolia, and there's no significant effect. So we think that the comparison still holds. Again, data for MENA and SSA Sub-Saharan Africa wasn't available just simply because of the newness of this research. Annualization of data. So we just decided to take the fiscal years of the FSPs rather than doing adjustments and annualizing the data on a year-by-year basis. And this is consistent with the mixed regional benchmark as well. And the final note we need to make here that correlation is not causation, and truly we do not have enough data to make any statistical conclusions in terms of correlation either. So this is really more of a survey and a deeper understanding of how FSP's bottom lines are being impacted in terms of benefits after incurring the cost of getting certified. We wanted to also give you the snapshot of EIU study results. You can see that in general, the conditions are getting better. However, for ECA, it declined until 2013, and now it's getting better again. And the reason for that is the Eurozone crisis that region was experiencing. A quick reminder of the events that took place during our period of 2011 to 2016. As you may remember, headwinds from mortgage debt crisis was slowing down around 2011. So around that time, there was a rush of investments in this space, and you'll see the results of that in our analysis. However, right about that time, Eurozone debt crisis started. In 2012, there was a downgrading of American bonds and worsening of the Eurozone crisis. In 2014, collapse of oil price and low inflation accompanied by worsening of the economy again. 2015, there was Brexit and Brexit, weakening of emerging economy, ECA impacted by European crisis. 2016, new regulatory standards in ECA was introduced, worsening of global economy due to political instability in the state. So these are broad financial events that definitely had an impact on everyone, including microfinance. And it's important to take into consideration any declines in results or growth as a result of that. Finally, we'll move on to our research findings. I like to start off with key takeaways in case we get lost in data after. So one of the key takeaways was internal efficiency was gained for all of our FSPs, meaning even though they experienced business growth, their internal costs didn't linearly increase with that, which is actually a really good sign because that's within their control. And it shows that implementing these strict client principles does not lead to increased costs, which is on top of the list of anyone who's looking to get certified. Secondly, there was business growth. And the reason this is impressive is because, as I mentioned earlier, they're all in the mature space in terms of operational years, and the regional cohort or benchmark does have a lot of newer FSPs, and you'd expect that the growth rate for newer FSPs is much steeper. But however, our cohort did outpace the regional benchmark, and we think that there are certain reasons for that, which we'll get into later. Lessons from the European crisis. So surprisingly, although ECA experienced decline in pretty much all across the category, the cohort, the SMART certified cohort, was significantly less in decline and were far more stable during this time of crisis. And that is perhaps due to having really prudent risk mitigation and client selection standards. They were able to retain and grow their client base. And I think that's a really important takeaway when one is trying to sell SMART certification. Finally, risk appetite. FSPs that are certified tend to have higher debt to equity ratios, most likely because there is more trust for external lenders to give them more borrowing. And secondly, they have excellent par level and the risk coverage is 100% all across the board. So these are very positive signals that's coming from our 22 FSPs. Now we'll move on to deep diving into some of the KPIs. The first one we're looking at is gross loan portfolio. This is a very basic key metric that everyone looks at the beginning. It's a basic driver of business growth. As I mentioned earlier, GLP did grow and it outpaced the benchmark for the post period. However, the pre-period did see a higher growth rate, and that's because during the beginning of 2011, when the financial crisis was slowing down, there was an outpouring of investment in the space. So it fueled a lot of growth and it kind of slowed down around 2013. But then again, there was some more investment around 2013, and we saw the impact of that in growth of number of borrowers in the post period. So the factors that we believe led to growth is overall market penetration of country or region, maturity of institution and operational years, and access to institutional borrowing. As I mentioned earlier, you can see that ECA experienced a negative 27% in growth, whereas our cohort only had around minus 3% in growth. So it declined at a much, much less rate. Next is number of borrowers. So this actually follows growth in gross loan portfolio. You can see that in the post period, number of borrowers grew. more so than the regional benchmark, and this is expected as our loan portfolio also grew at a higher pace than the regional benchmark. Again, it's not as steep as the pre-period for the reasons mentioned earlier. And a couple of other points that I want to mention is that there's a trend towards reaching more down market customers post-certification, and this is encouraging because it shows that they're reaching out to lower income clients. That is the social impact that most of the FSPs in this space are trying to have. And this is discussed more in depth in the poverty outreach section in our paper. Also, I would like you to note that in South Asia and EAP, they mostly employ village banking, and in the rest of the regions, they usually employ individual banking. There are consequences of that, of costing, and we will see that in our next KPI. And the other factor that I think that led to this growth in number of borrowers is that our FSPs have diverse products, they have better interest rates, and they have more outreach efforts. And these are things that we have discerned or gleaned through looking at the technicals of our analysis. So now we'll look at portfolio quality and portfolio at risk over 30 days. This is a really important indicator in this space. It's generally accepted as pointing out the riskiness of the portfolio. It shows how delinquent the clients are. We generally want to see a delinquency rate of less than 7%. And for all of our FSPs, that's the case. Even in EACA, you can see that PAR was at 10%, which is really, really high in the post period. However, for the SMART certified FSPs, it's at 5%. All of the other regions have either shown improvement or they have remained stable. And this is despite experience growth. This is impressive because usually when FSPs experience growth, they tend to loosen their credit standards, which leads to more PAR. It's just an effect that's observed in the industry, but this was not the case for the SMART certified institutions. The other point is that PAR 90 indicates that the FSPs have sound collection policies in place, as it's lower than PAR 30, and this is also discussed in depth in the paper. The second point, when considering portfolio quality, is risk coverage. All of our FSPs that are certified have more than 100% risk coverage. This is important, again, because the loans mostly are non-collateralized. So when a client is unable to pay their loans, there isn't anything that's guaranteeing their loan. So the financial institutions have to keep a reserve to cover those delinquencies. And all of our FSPs cover these delinquencies a little bit over than 100%. So this gives a lot of comfort to their lenders that they will not go bankrupt. You can also see in the chart here that most of the regional benchmarks have around 50 to 80% in terms of risk coverage. So now we'll move on to efficiency indicators. We're looking at cost per borrower. This is a really common metric that is looked at in the microfinance space. Again, you can see that in South Asia, the cost per borrower is around $20 to $30, and this is due to a low-cost environment that's prevalent in South Asia, and also due to village banking that's far more prevalent than the other regions. In terms of EAP, although village banking is prevalent in that area, our cohort for that region does not engage in village banking. It focuses more on individual and micro enterprise lending, which is leading to the cost per borrower over closer to $200 that's observed in Latin America and ECA. So the interesting piece about this is cost actually decreased in the post period, and it's lower than the regional cohort. As you may recall, our regions did experience more growth. However, their costs went down even though they're certified. So this is a very encouraging story that emerged from our analysis. Next is financial management. I have selected debt over equity ratio. I think we're all familiar with this ratio. It's widely used in the commercial banking space and microfinance as well. The debt over equity is an indicator of how leveraged an institution is. As you may recall, more leverage includes to multiplying of profitability. You will see more profits if you're more levered. However, there is a sweet spot that one needs to maintain here. If you're too levered, your losses are also multiplied and it leads to bankruptcies. So one needs to lever in a way that where the debt is still serviceable, but not so much that an institution becomes too risky, and that sweet spot differs from industry to industry. As you can see, South Asia is more levered. There was an outpouring of investments in South Asia for the period that we're looking at. EAP also has a high leverage close to South Asia. Latin America and EECA, Latin America is in a saturated space in terms of lenders, especially the banks that we selected. And EECA was experienced Eurozone crisis, so there wasn't an outpouring of investments in that area for the time that we looked at. And another finer point that I'd like you to take away from this is, so when you have more debt, you actually incur more costs. And when you incur more costs, that usually translates into higher interest rates for the client. However, for our cohort, this was not the case. We actually saw a decrease in financial expenses and a decrease in financial revenues, which means that they actually passed on some of the cost efficiencies to their clients. And it's also likely that they received good rates on their debt. Finally, we'll look at profitability. Return on equity, I'm sure everyone's familiar with this as well. It's a very key metric that lenders and regulators will look at, especially lenders. In general, you want to see return on equity go up. In our case, in the post period, for the most part, it's going down, although it's better than the regional benchmark. And the reason for this is, again, this is a really technical point, is equity probably grew at a faster rate due to investments than returns. And as we said, some of the cost efficiencies were probably transferred to the clients, which led to growth, but at the same time, a lessening of revenues and expenses. So this isn't too concerning. It's expected, but it certainly doesn't give you a very clear picture to paint. Finally, profitability, again, portfolio yield. This is, again, a really important metric to look at in the banking space. You can see that portfolio yield is at par with the regional benchmark for the most part, although it decreased this period. This is expected as the industry is maturing. Although these are really attractive rates compared to other types of investments, it is expected to decrease as the space continues to mature. So I guess in conclusion, all across the board, the regional benchmark is doing better. I mean, the post-period results are better than the regional benchmark, which is a really promising story. However, you know, it's not, when we compare pre to post, it's not as clear all across the categories. There are some anomalies here and there that we try to explain through normalizing the background noise. Finally, I'd like to leave you with some forward-looking statements. I think we think that it's a good idea to continue research on financial for smart certified entities because we want to encourage MFIs in this space to continue to employ client protection principles, not only because it's the right thing to do, but also because it does impact the bottom line positively. We can do deeper dives and gain more insights. We weren't able to touch on a lot of topics like how deposits impact the results or how multi-channel and diverse products affect growth in business, because those are also tenets of the client protection principles that could be analyzed and looked into. Finally, benchmarking is a valuable asset for various reasons. And this methodology, although we have simplified it, it can certainly be more sophisticated going forward when there's more data available. So we're at the end of our presentation. I'm sorry it was so technical, but I hope that it was insightful and helpful in terms of figuring out the costs and benefits of smart certified entities. With that, if you have any questions, now would be the time.
Fatima, thank you for that presentation and for taking us through some of the highlights of the research. As Fatima has said, if there are questions, please let us know. You can either type that in your window or there is a feature to raise your hand if you're familiar with that. So we'll leave the line open for a few seconds and see if there are any questions that are emerging. In the interim, I do want to say that, you know, one of the big things that we've really tried to underscore in this research project is that we're seeing lots of correlations that are positive that we believe are somehow tied back to the practice of becoming SMART certified. And so while we can't make a causative statement that would require a whole other type of research project, we believe that there is value in looking at future studies that try to capture more data on a larger group of SMART certified entities as those entities gain longer term financial results that you can then look at and track over time. So we're hoping that for those of you in the industry who are committed to this space and to ensuring that financial services are responsibly delivered, that you do sort of put the investments in there to ensure that we can tell a longer term story on the financial results of SMART certified entities. This presentation is recorded and will be available online. And so we will circulate that to other members of the community who were unable to join. Thank you, everyone.